Restricted stock units are one of the most common forms of equity compensation for tech professionals. Companies such as Google, Salesforce, and Facebook often offer restricted stock units as part of your sign-on package or as part of your annual compensation review. The stock units that you receive are restricted because there are conditions attached to them. These are criteria that you must meet before the shares in the company become yours. The criteria could be performance-based, but is more commonly restricted based on the length of time that you spend at the company. You will be granted RSUs once the company offers you this form of compensation. However, you will only receive the shares of company stock according to a vesting schedule. A restricted stock unit is not an actual share of stock in the company. It does not give the holder rights to vote at an AGM, nor does it convey the right to receive dividends until after the RSUs have vested. An RSU is a promise from the company that you will receive a share of stock for each RSU at the vesting date. The grant date is the date that your employer awards you the RSUs. The vesting date is the date that your shares of company stock become available to you. The vesting schedule outlines the timeline of how you will receive company stock for your RSUs over time. The vesting schedule will be defined by your company. It is common for RSUs to vest over 4 years, where, for example, 25% of your shares become available to you at the end of each year. If you leave the company before a portion of your RSUs have vested, you will lose the right to receive these shares. The vesting date is the date in which you receive a certain number of shares from your employer. It is this date that is used as the basis for calculating the amount of tax that you owe. On this date, the market value of these shares is treated as income, and you will pay regular income tax on this amount. Typically, companies will withhold this tax for you by taking a portion of these shares and selling them to cover the taxes owed. The way you should think about whether you should sell or hold the shares is to imagine a scenario where the company has given you a cash bonus equal to the market value of the shares. For example, if on the vesting date, instead of receiving 100 shares worth $10 each, imagine you received a cash bonus worth $1,000. Would you then take this $1,000 and invest it in company stock? If the answer to this question is yes, then you likely would want to hold the shares, and if the answer is no, then you might want to consider selling the shares. Another thing to consider is diversification and concentration risk. Over time, RSUs can add up to become a significant proportion of your income and an outsized proportion of your net worth. In order to diversify your portfolio, you may want to sell some or all of your shares and invest this money in an index fund or other investment. Another factor you may want to consider is the growth trajectory of your company. If you believe that the future of your company is very bright, you may want to consider keeping these shares in order to benefit from the capital appreciation of these shares.